good afternoon, everyone. Welcome to this TradeStation webinar, dedicated, of course, to options analysis and be able to, analyze the markets and understand the reason why we're placing certain trades or certain options spreads than others. So it's a great opportunity for us to put everything in a practical setting, just to understand the reason behind doing a particular trade and why it works or why it doesn't work. So it's not all about, how a trade is profitable, but also how a trade could have turned better if we could have, done something different. So before we get started, just the usual introductions. If you've been to my webinars, my name is Jesus Nava. I'm the Director of Education for TradeStation Securities. And today we have a guest speaker, Brandon Wendell. He's a trader, he's an educator, and he's done this for many years. So we are very glad to have his expertise with us today and for him to share his knowledge with us. So before we get into the presentation, the usual disclosures, just keep in mind that every symbol and idea that we talk about is for educational purposes only, that these are not recommendations of TradeStation. And we all need to be aware of the risks when trading online, especially when you're trading options, which carry a higher degree of risk. And any example that we talk about today, is no guarantee that you'll have the same success going forward. So always be aware of those risks. For additional details on these disclosures, go to www.tradestation.com/important-information. All right. Before we go to passing the microphone over to Brandon, I wanted to remind everyone of the Options Education Center. I had it open just a moment ago, but it will just take me a few seconds to go there. The Options Education Center, it's a new portal. It's not new, it's been around for a few months already. If you haven't been to the Options Education Center, just go to tradestation.com, learn, and you see options education in there. We have articles on popular option strategies and all the education behind each one of them, the settings where you could apply these types of strategies, and also webinars where we discuss those strategies in much more detail. So I'm going to show you come here. If you're looking for this particular session's archives, notice that there's a banner inside of the Options Education Center for the options replay. It allows you to register for upcoming ones, even though, we made this a recurring webinar where if you register the first time, you should be getting these reminders every 2 weeks about us meeting at Options Replay. But if you want to watch any of the archive, just click on Watch Previous, and then it'll take you to a page where we're going to, host all the archives of these presentations. All right, everyone. Thank you for being here. I'm going to mute my microphone and pass the floor over to Brandon. Brandon, you still there?
There we go. Yes, I am. I want to thank you for having me back.
I was going to say, well, thank you for joining us, Brandon. And let me just mute myself. And every so often, I'll just, interject and ask you some questions, maybe from the audience, if we can. Okay.
Absolutely. Yeah. I want to thank everybody for being here again this week, and welcome everyone. As Jesus mentioned, my name is Brandon Wendell. I'm not going to spend too much time on me because it's not about me. It's about you guys and about the options market. So let me go ahead and share my desktop with you. I've been here with you before, and here we go. I'll go ahead and share. Should be looking at my OptionStation Pro right now, hopefully. And we started off last week kind of talking a little bit about calendar spreads and going over a few things in the platform. We're going to stay focused this time. What we're going to be doing is talking about vertical spreads, and you'll see that I do have several of them open currently, actually looking to put in another one. I don't think my order was filled. It was GTC. So we'll talk about that as well, what to do and how to adjust using the platform. But I mentioned that we're going to focus on comparing and contrasting two different vertical strategies, basically. And what we're looking at here is basically a CNP is the security I chose. And I'm going to go back and kind of take a look to show you what happened from the beginning of the position all the way through to where we are currently in this position. I'll open up the correct workspace. And let's see, open workspace. There we go. And by the way, the workspaces that I'm using are available to pretty much everyone who wants to use them. They were uploaded. If you go to TradeStation, let me see, this should be in my documents maybe. There it is, TradeStation 10.0. And my workspaces. Actually, I could bring this back over here anyway, but you can see that basically all the different workspaces that are there. If I were to go to my browser, which I should have opened as well. Oh, it's here under TradeStation. If you go to the options education that Jesus was mentioning a little bit earlier, that's where I got these workspaces. And you can use them. The directions and information is there as well. So when I'm looking at, say, for instance, a bull call spread, a debit spread that we're going to be talking about, you just click on that if that's what you're interested in learning more about. And there's the webinars that we previously held. There's articles and videos, of course, there as well. But this is what I wanted to focus on, download workspace. And when you download the workspace, there's a PDF that goes along with it that explains what's in it and how to utilize and upload. So going into the actual position or platform itself, again, going into TradeStation right there. And what we've got is the bull call spreads. Actually, I take that back. I was looking at a bearish trade. So I'm going to look at bear call spreads and bear put spreads and open those two up. I noticed I was able to open up two workspaces at the same time. I held the control key down and selected them both, so it'll both open up. By the way, if you have any questions, feel free to ask those. I'm going to go ahead and collect those, and we're going to answer those at the end to keep this kind of on point and tracking. So, like I said, our agenda for today is going to be talking about the differences between two vertical spreads, primarily on the bearish side today. We'll look for bullish next week, perhaps, or next session. We do this every 2 weeks. But the first session, again, I went through using these two workspaces, bear call spreads and bear put spreads, to try to identify some potential trading opportunities. And I apologize, the computer's running a little bit slow. There we go. And now you should be able to see the screen again. So we will be doing trading on a lot of different strategies. Yeah, we're going to cover a lot of different strategies as well. So here we are looking again at bear put spreads. And what happened was at the time, now it may not be the same as of right now, but at the time I ran through these different scans, and this one is actually on the S&P 500. Again, all the filters, everything that's all in the workspace, and it's explained in the PDF as well. So if you have questions about that, obviously you can ask here in options replay, because this is going to be one of the places where we're going to be interactive more often than not, talking about the platform and how to actually apply these strategies. But the education itself for the individual strategies will be in that the Options Education Center, as I mentioned, and we're going to be kind of going over it as we do these things. So what I found was, it's not on this list currently, but CNP was a security that showed up on my list. And I'll click over here to bear call spreads. You'll notice I have multiple lists here. We have an S&P 500 list, which obviously is populated with the S&P 500. But the neat thing about TradeStation, if you're not already aware, you can incorporate hot lists into your radar screen. And it's very easy to do. Mine should be populating soon here. Again, there it goes. I can click different tabs and they're already incorporated. But if you want to add a new one, you just click data and right there, add new page, hot lists. Now, the only thing you'll have to do is, and I might as well do it. I'll walk you through this and show you. I'll click on hot lists and it's going to create a brand new page for me. Oh, actually, did I do it right on top of the one I already had? That's okay. What I should, nope, there it is. I was right. It did bring up a new page, but notice it looks different. Well, that's okay, because what I did prior to doing this is I saved under settings the template. Now, if you didn't save it, just go back to one of the other pages, just as that's easy. Right here, the way I like it, with the text and all the columns set up the right way. So I go back to that page, settings, templates, and save it. So that way, when I go back over to the new page I created, first of all, the indicators aren't the same and it doesn't look the same. So to get it to look the same, I go to my templates, apply, and I should have save templates, which actually, oh, you know what? I realized they're on my other computer. So now you get to see me actually save the template, which is even better. So I'll just do that. You can see how simple it is. Save template. I click back between multiple computers. So this happens to be the bear call spread template. I'll just say bear call spread radar screen. There we go. And now going back over to the other page, actually, before I go there, let me do one more thing on my hot list that's already set up with the indicators I want, I'll go to studies and I will save the study group as well. So I'm going to save that, and you can see it's got all the pieces, and I can unclick if I don't want to transfer any of those over, but I'll call this one bear call spread radar study. Oops. ST.
Hey, Brandon, and we got to do
Yes.
that because the looks, like the colors and styles, are saved in the template, but not the
Correct.
columns, right?
Right. The indicators and the columns themselves specifically are part of the studies, while the looks and the colors and the setup, the width, all that stuff is in the template. So yeah, I'm glad you made that again. I wanted to make sure that that's why I'm doing both of those,
Mm-hmm.
because if you only do one, you're missing one piece. So this is all together. By the way, Jesus has a getting started series that he's done, which goes through a lot of this as well. But specifically for what we're doing here in options, I figured I'd hit on some of this to help some of you out who might not be aware that this is available for you and how to do it. So again, now that I'm on the new page and I have saved both the template to get the look and the studies group to get the columns, now I can just import them. Just add them in, templates, and apply. And there it is, radar screen. And you'll see the colors and the font will be the way I want it. Now I don't have the right studies, so I simply go to add study group. And there it is, BCS radar studies. It'll override and overwrite, excuse me. But I did make one error before I went over here, is I forgot to change the time frame. Not a big deal. I go change my time frame now and actually click the entire column and change them all, because this only works on daily for some of those studies. But you see how now this column and this workspace is identical to the other radar screen not workspace, excuse me, the other tabs, other pages I was using. So now if I wanted to, I can scan for, percentage gainers, losers, volatility gains and losses. There's a lot of different little things you could study for, or sorry, look for here. If I'm looking for volume, most active securities based on calls or puts even, or option activity. So that's pretty neat. Anyway, that's just kind of a little side extra. I wanted to show you how that was all set up and how you can customize, even if you have your own special list that you like to watch. Instead of opening up under data and a hot list, you can actually create your own symbol list as well. You can create custom symbol lists and other symbol lists that are preset by TradeStation and scan those as well, which is really nice. So I did this previously, that's the trust me on this one, because looking back, as a matter of fact, you don't even have to trust me on that. If I go back, I do have screenshots on all of this. So basically, I'm going to be opening up these screenshots, and what I found was CNP. And actually, I'm going to make it even easier to see on CNP by going to my big chart. But this showed up as a possible bearish security that was getting ready to most likely drop, obviously, if it's bearish. And you can see why when I go and enlarge this a bit. So when I originally, let me find the first chart. Wednesday, nope. CMP daily, I believe that is the right one. Let me open up on my other screen. There it is. That's what it looked like on the day that I was looking to enter into this position. So what happened was I had CNP, perfect. And I saw the security that was in a bit of a bullish trend. However, it was coming up into an area where prices looked like they were getting ready to drop. And not only that, but this is on the daily chart. If I go to the weekly chart as well, you can see a couple other things that were going on here. On the weekly chart, it actually even looks a little more dramatic. And what I was looking for was, again, a bearish security, okay? And the indicator information is in there as well, yes, by the way. But right here, you can see we have an area where prices had paused a bit and then collapsed. Now, this is on the weekly chart, the much bigger picture. So I anticipated that this was likely to repeat itself, because this is an area where there's a lack of buying pressure, what we call demand. However, there was definitely enough selling pressure to push prices down. You get large candles like this because of imbalance between buying and selling pressure. If you think about it, think back to the housing market in 2006. Okay, that's before the crash. If people wanted to sell a house, all they had to do was list it. And even nowadays, you list a house, you'll get multiple offers, probably above the asking price. Same thing happens if there's a lot of demand, a lot of buyers of a particular security, they will scramble and try to attract the sellers by raising their prices. What we see here is what happened in 2008, the opposite. If you wanted to sell a house in 2008, early 2009, the markets were crashing, you couldn't give it away, right? They actually had what was called jingle mail back there. Basically, people were mailing their keys back to the lenders. So what happens is if you want to get rid of a stock and there aren't a whole lot of buyers around, like in this area, you have to aggressively drop your price to that area to find any buyers. Well, they had to drop it much faster than they had any other week, right? So price-based activation rules don't work for indices. Well, we'll take a look. It does. It should. Anyway, we'll talk a little more about that later. But basically, this is an imbalance. And the indices work the same way, price-wise. So you're seeing an imbalance of a lot of selling pressure, very little buying pressure. The other thing I noticed is we had a lack of momentum. The indicator you're seeing here, it's not showing the indicator itself, but it's actually RSI, Relative Strength Index, or RSI, Relative Strength Indicator. And I have it set a little bit different. I'll go over that another time, but I actually use it slightly different than most people use it. Most people use it to identify overbought or oversold situations. And most people say if something's overbought, it's probably going to drop. Or if it's oversold, it's probably going to rally. That's not necessarily true. When something is overbought, it can become more overbought. We call that a bullish trend. If something's oversold, it can become more oversold. We call that a bearish trend. So what I'm looking at here is the fact that the last time we had strong rallies, we had lots of bullish momentum. However, here you'll notice we've got a strong bullish rally without the momentum. Well, it's unsustainable for you to continue moving in a bullish direction if the momentum is weakening. It's like a bridge with supports. The bridge needs those supports to keep going up and to maintain, even coming down. But if you take those supports away, the bridge eventually is going to give way. There's nothing to hold it up. And price works the same way. So what I noticed was, okay, we are bullish, definitely, even on the daily chart. And actually, I can go back to the live chart, as I said, right here. And this is now the weekly chart. Oh, sorry, that's the picture again. We go back to the live. There we are. And here we are on CNP. Okay. So if I go back to the weekly, you can see that, again, there was an area where prices had just slid down. And if I bring in my studies, I'll add that study again. And there it is, RSI. Now I do a little bit of a change here. First of all, I like to be able to see them. I'm getting a little bit older, so I make the line a little thicker there. These are just blue blockers. They're not for anything other than keeping me from getting headaches, but I do adjust the inputs. For overbought, I use 60, and oversold, I use 40. So there's one adjustment. I'll actually zoom in so you can see that better. So all I do is I thicken the line a little bit and I change the overbought and oversold numbers. And the reason why, if you're in a strong bullish trend, you should continue to see a lot of bullish momentum. And if you fail to go above 60, your bullish momentum is actually waning. It's getting a little weaker, and you're less likely to continue the trend. If you're in a bearish trend, like I was saying, you should have a lot of bearish momentum and continue. But if you're seeing less bearish momentum, the RSI will not typically go below 40. And that shows you weakness in your trend. So that's what I'm using, and that's how I'm using it. So I'll insert that indicator, and you can still see that we are failing to get above 60. Now, it's not perfect, but more often than not, you can see when the RSI fails to get above 60, it's very difficult for price to make new highs. And if price does move down, for instance, as a matter of fact, let me bring in the drawing here. Oops, make it even easier. For me, no, drawing toolbar. There we are. You'll notice as we're moving down, if the RSI isn't going below 40, we're not making new lows. But if the RSI does dip below 40, even a little bit right there, you're making fresh lows in price. Right there, before it made the low. Obviously right here, again, before it made the low. So it works both ways. If you're able to go below 40, you'll probably make new lows. If you're not able to, you're probably going to stall out on the downward trend. In an upward trend, it's the opposite. Notice this upward trend, we're not going below 40. You're not becoming oversold. And a lot of people look at this and say, well, that RSI is useless. It's not going below 30, so I don't have a buy signal. Well, right. You're in a bullish trend. You're not going to get that signal. So you got to use things a little bit differently, probably in a better way, if you will. Just look at it differently. It's a momentum indicator. That's how I use it. So as long as we go above 60, bullish trend, right? But if we stop going above 60, or heaven forbid, now we're below 40, that bullish trend is probably ending and ready to reverse. And look at that. The trend stopped going up. We went sideways and even down. So I'm just giving you some of the background as to why I decided to go bearish with this security, other than it showing up in my scan. So just because it shows up in the scan doesn't mean automatically I got to apply that strategy. Just because I have a bear put spread identified in my scanner, and again, I've got a lot of securities here. This is the S&P 500. We got, let's see, ADM, Archer Daniels Midland. I click on the security. It'll load into my chart. And I do have RSI there, notice. And on the weekly chart, daily chart, daily chart, ADM is just going sideways. It really doesn't have momentum in either direction because we cannot exceed either above 60 or below 40. Well, take a look at price. What's it doing? It's channeling, which would be great for another security that we could trade. Maybe we'll put this one into our next idea, possibly an iron condor. Okay, what you have to do is identify what kind of trades you're looking for based on what you're seeing with price. And I think I mentioned this last week. Overall, when I'm looking to do a position, doesn't matter if I'm looking to do an options trade, a futures trade, a Forex trade, a stock trade, doesn't matter, indexes, anything. I start off looking at the screen at the security, the underlying security that I'm going to be trading. And I actually look at it at 3 different time frames. You can go back to last week's video and I talked a little bit about that. So I don't want to get too much onto it individually right now, because you can go back and watch that one. It should be recorded and available. But one of the things I do want to mention is when I'm trading options, I think I might have mentioned this too. I want to keep it as simple as possible. Okay. And what I mean by that is, it's not easy. Don't confuse simple with easy. Okay. Simple means there are simple rules that if we follow, we should have the desired outcome, the desired effect, results. Now, the result's not always going to be a win. Okay. But we should be consistent in what we do. So with options trading, it's simple, but not easy, because there are a lot of things we need to think about and do. But to keep it as simple as possible, number one, analyze the underlying security. And I did mention this last week or 2 weeks ago. I keep saying last week. It's been 2 weeks. We're doing this bi-weekly, by the way. And of course, if you have questions in between, you email us or email TradeStation, really, and they'll get it back to me. And so, let us know what you're liking or not liking and what you like to see going forward. But anyway, we analyze the underlying security. Are we bullish, bearish, or neutral? If I can spell today. And that kind of gives me an idea of what security I might want to look at, or sorry, what kind of strategy I may want to look at. So basically, it helps to identify strategy. I mentioned ADM looks like it's channeling. Well, if I'm a neutral position on an options trade, I'm probably going to be looking for condors or iron condors. Those are neutral types of positions, or maybe even a short strangle if I could do that. It just depends on what your level of options sophistication is, meaning how much experience you have and how much capital you have as well, how much risk tolerance. Number two, and we're going to look at this a lot more today, are options cheap or expensive? And that's going to be kind of studying, in a way, if you will, implied volatility. Now, it is not the sole thing that determines the pricing of options, but implied volatility does have a pretty big impact on whether options are relatively inexpensive or relatively expensive. Typically, volatility rising will often cause the value of options to go up, meaning you will have to pay more to buy them, or you will receive more to sell them, and vice versa. If implied volatility begins to drop, then you should expect the option values to potentially, the premiums to drop as well. So you could either sell for less or buy for less if you need to cover something. So implied volatility impacts option premiums. And if options are relatively expensive, and I say relatively because there's not, I wish there was a number you could use, a percentage, whatever it is, that always works this way. It doesn't. Sometimes it's a certain percentage of volatility that's very expensive. Sometimes it's completely different. It matters based on the security itself and previous pricing as well as volatility. So it's relatively expensive. You would most likely want to sell options and basically do what are called credit spreads. If options are relatively cheap, and I need to capitalize that, then obviously we want to buy options. And we would want to do debit spreads. And I actually put in one of each on CNP. And the reason why is I wanted to compare why one worked better than the other, if they did or didn't. Okay. So number 3, once we have all that information, we have an idea of what strategy we may want to apply when it comes to options, and we know if they're relatively cheap or expensive, we choose the right strategy. Based on market conditions. And not only are we doing that based on the market conditions, but we're also taking a look at a lot of other factors, the Greeks themselves, risk parameters for the market, risk parameters for ourselves, our tolerance, what we can afford to take, what can we afford to lose. A lot of people will look a lot at how much can I possibly make on this particular position? And that's not really the correct question for most traders. The correct question is, can I afford to lose what this position might cost me if I'm wrong? That's the correct question. If the answer is no, then you don't want to take that position, obviously. If you can handle and manage what might come to it, if it goes against you, or even if it goes for you, sometimes things don't completely work out the way you want them to. You got to make sure you're understanding what kind of risk you're getting and losses you might be getting yourself into. So as far as cheap or expensive, I don't use the IV. Well, I do use implied volatility. Yes, there are tools on the indicators, or sorry, indicators that we look at. We're going to do that now. So the RSI and MACD can help me with a little bit with the trend and strength. This was a poor example as far as trending, but it's a great example for sideways movement because as you see, ADM is moving sideways and the indicators are telling me that. So when I went back in time, I thought I had it as far as a chart, and I apologize because I don't see. Let me find. Yeah, the CMP weekly and the CMP daily charts that I mentioned. So what I was looking at was this situation, and that is the daily times 2. Where did I put the weekly chart now? And the weekly chart, there we go. There. So like I was saying, on the weekly chart, I had a security that was rallying from way below 40. It was very oversold, and that means it's unlikely to create a new high without some sort of a correction first. Additionally, here's one of the indicators. This is implied volatility, all options, and that's available obviously in TradeStation. So if I go back, that's a picture again. Here's the platform. And if I go back to my one chart, I can go ahead and bring that one in as a study as well. Implied volatility, all options. And there's several different tools you could use. This is just one. But right there, again, I try to keep it as simple as possible. And a simple way of figuring out if implied volatility is high or low is using that implied volatility, all options. So add it in, and I am not getting good data for some reason. That happens sometimes with this particular account.
I think it
If I
went to
can
the same
log
sub.
out. Sorry?
Did it go to the same subgraph or?
No, it's in the subgraph too. It
Oh,
should be.
it is, yeah. Hmm. Try doing Control R.
This is refresh.
Mhm.
Okay. Yeah. Maybe no, it shouldn't be a problem with maybe if I go to daily. It shouldn't be a problem though. I don't know why that happens sometimes to me.
Hmm.
But anyway, I have the picture of it anyway, so there you go. That's what it was looking like. And you could see at the time, my implied volatility was a little bit higher than the average. Okay, it would have been better if to show you the drastic difference between those by seeing something like this. This red line is the implied volatility average. This yellow line is the implied volatility of all the options, and it's showing all the options of the front uh, closest monthly series, I believe. And if you ever have any questions about what an indicator is showing you, so again, I'll go back to my live platform here. And right here under edit, I'm going to change that to the actual color I was using so they look the same. I apologize. Should have had that defaulted. There we go. So I have the yellow versus the red, which is the average. But you can go in and it's not here. It's actually when I add in the studies, implied volatility, all options right there. If you click on definition, it'll actually tell you what it is, what it's measuring, and how it measures it. So that's kind of neat. I'm not going to go into it right now, but that's what it does. So I saw that we had slightly higher implied volatility than average, but it wasn't really all that high, was it? In comparison to where we've been spiking before, we were just barely above the average. So I had a choice. Options weren't necessarily very expensive or very cheap. They were kind of in the middle. So I could have gone with either buying or selling options. In this case, I was bearish. I mentioned some of the reasons why it wasn't bullish enough to continue through this area on the weekly chart. Plus, we're hitting this area of supply where we're likely to see prices move down. And the same thing happened on the daily picture as well. If I go back to that one, here's the daily picture. Now, we were a little bit higher on the RSI here. We were above 60, so we were possibly going to be able to push through, but that weekly trend was what I was really looking at and expecting a pullback before we make new highs. So I was expecting a little bit of a move upwards before the prices stall out and fall back. And you can see that right here, we actually have just slightly higher volatility than we've had in the past. Again, that meant that I could have been either side, buying or selling. So for next week, again, I'm going to be looking for a little bit more dramatic of an indication of volatility to show you the difference between buying with high volatility or selling with high volatility, or buying with low volatility versus selling with low volatility. And you'll see why volatility is very important to be looking at. A lot of people ignore that, but when you look at the options, and I'll go to options chain, there you go, Option Station Pro. So when I go to the options chain, and you'll notice that one of the things I'm looking at are all the different Greeks, delta, gamma, theta, vega. I don't look at rho as much because that's not as important to me right now. But most people will tend to ignore everything but delta. And delta tells you how much premiums should change based on the underlying security changing by 1 point or $1. Well, in reality, when it comes to the movement of option pricing, Vega is probably one of the most important pieces. Okay, now they're all important. You know, delta tells you the rate of change for the underlying premium based on underlying price. Sorry, change of option premium based on underlying price. I want to make sure I say that correctly. Gamma is the acceleration factor of delta. Theta, that's easy, time decay. That's how much the ice cube melts. I think last week I mentioned these options are like ice cubes. You know, as soon as you take an ice cube out of a freezer, it starts to melt. Options decay in value every day based on the how big the ice cube is. If you have a lot of time left, you got a big chunk of ice, they don't melt very quickly. And if you have little time left, they typically melt faster. And then Vega is volatility and how much volatility will affect the pricing of an option. So if I just look at a common security like Tesla, most people will say, well, okay, I want to trade Tesla. I think it's bullish, but I don't want to spend, well, I've got cheaper, it's $261. Should probably pick a more expensive security, but Anyway, we take a look at Tesla, the volatility. But basically, I would look to see how is volatility affecting me, because that volatility can really change prices. And I'll show you how and why in a moment right here. If I just pick, for instance, I think it's going to go up, so I buy a call. And again, before I go any further, you see that this has 17 days left till expiration. Let me get, there we go. If you go out, say, not even too far, 100 days left till expiration. That's 260. Here's the 260. And you can see that, well, volatility, 56 cents versus 23 cents. Volatility has a much bigger impact when there's more time left until expiration, because there's more time for something to happen. But it's balanced out because look at the theta here. 50 cents a day per share versus only 16 cents per day per share. So you've got to figure out which is most important to you. And as a rule of thumb, again, this is not set in stone, but you'll see this in notes and in the videos, on the workspaces that are not on the workspaces, but the actual videos where, say, for instance, you go into bull call spread and you go to these articles and the videos, they'll talk about this. When you are doing a certain strategy, say, for instance, bull call strategy, bull call spread, that's a debit strategy. You're buying options. Remember, we want to buy options when they're relatively cheap, right? Well, we're also going to want to buy time, because this ice cube is going to be melting. And if you buy an ice cube with only 17 days left until expiration, it melts very fast. If you buy an ice cube with 108 days left, it melts very slow. And people complain, they say, but Brandon, I'm going to be paying this much more than this. Think of it as a deposit. You know, some of you are older like me, and you remember when you used to take the bottles back, you got deposit money back from when you bought the cases of, I used to get A-Treat as a kid, the bottles, and you would take the bottles back, you get your deposit back. Same thing here. Yes, you may be paying more for the option, but that's going to protect you from some of that time decay. You will get a lot of that time value back when you exit the position. So I was saying, as kind of a rule of thumb, if I'm looking to buy, I will often buy with anywhere from 60, here we go, debit, using, and I'm not saying you have to do this, it's just a guideline that I've been using for many years in trading, minimum of 60 to 90 days to expiration. Cannot type today. There we go. However, if I'm doing selling, so we're doing credit, I want that to decay, because remember, you're selling first. You want to buy back when things are cheap. So you want that ice cube to melt, so you get to buy back the sliver. So in that case, I use a maximum. It depends. Sometimes 60 days, depending on the strategy, or less. And really, that theta, that time decay, is much greater with 30 days or less. So often, I'm just going to edit this, and I'm going to have to go all the way back. There we go. So often when I'm buying, I will buy options that are much further out. I'll pay more for them, but I recoup a lot of that time value because it doesn't disappear. It doesn't melt away like it would have. Versus if I'm selling, I want to sell very short typically. So again, going back to the CNP analysis, and let's see, where was the initial entry? CNP BCS, bear call spread. There we are. Bringing up the photo for it. And this is what I looked at. I believe I used the October options in this, which I probably made an error on, because if I go to the bear put spread, and I forgot to transfer that picture over, didn't I? I have this one. You'll see that I actually use the same options. And that's an error that I actually made in doing this, because if I use different options on the buy side, this is the sell. Actually, let's go to the live one now. And we go to the manage on the positions here. Okay. And there we are, CNP. That's weird. On this computer, separated them again. Not a big deal. Put them back together. Oops, come on. 1, 2, 3, 4. There we are. And we have, there we go. Got it. Now we're good. Now let's see. Did it give me the chart? Nope, still not there. Anyway, at least I got this option data. That's what I wanted right there. And what I could do, because it separated them, I'm just going to drag them together. And the puts are together and the calls are together. So there we go. So we got the bear put spread and the bull call spread. And like I said before, one of the errors that I made right here was on the bear put spread. This is the debit spread where I bought the 29 strike and I sold the 26 strike. The error that I made is I didn't do enough time. And therefore, I was being affected by that time value that's being eaten away every single day. If we go to CNP on the security up here as well, I want to be able to see that. And there we go. You can see center point energy is at 29.42 right now. So this is, it's not showing, but it's actually in the money. Oh, sorry, no, that's out of the money. This is in the money just slightly. There it is, 42 cents in the money for that bear call spread where I sold the 29s and bought the 31s. And the reason why I was thinking this one would actually work out a little better. Now, there's still time left for this to work out. We're not quite at that crunch point. And well, for the longs, I kind of am. This is where we're really going to start getting hurt because the time value is really going to decay any potential profits when this starts turning to the downside. For instance, at this point right now, if I analyze this, let's see, analyze duplicate. There we are. I didn't have to do that. Actually, I could have just clicked this one, which is the actual position. Let me delete this. There we go. So now I'm analyzing the actual position. You can see right now how bad it could be, even if prices do move in my favor, because there's very little time left. Right now, we're looking at on the last, these are what are called price slices right here. So I can create as many as I'd like. And this helps to analyze and kind of foresee what might occur in the future for those options positions. And this can help you when you're trying to decide what might be the best strategy. Are we really overpriced or are we underpriced? Should we really be buying? Should we really be selling? And I could even go into this right now. As a matter of fact, I'll create one more position in a moment. I want to continue on with this thought first. So the current price is 29.42. That's where the price slice is. It shows us the theoretical profit and loss based on the position that I took initially, which was going long. And let's see, I did a cost, I guess, of 18 cents. Is that right? Or is that the current price? Because it shows me, oh no, there it is, max loss. I paid 45 cents right there. That's how I can tell. 45 cents is the max loss. With the debit spread, you cannot lose more than what you paid for the options. You know, worst case scenario, these expire worthless. I lose the 45 bucks. That's it. So I paid 45 cents to get in. And the current price or current value looks like it's about 18 cents. So if I were to go, this is where the 18, 29, 26, again, CNP. On the put side, you can actually see them because it shows you where I have an open position. So again, if I were to create this position once again by buying the 29s and selling the 26s, there it is, limit price, mid price right now is 18 cents. So that's what was showing the current price. Now, you also have to be careful when you're trading. TradeStation will show you what's called the mid price, and that is the difference between the bid and the ask for both options. That doesn't mean you're going to get that price, okay? Remember, if you want to buy quickly, if you were to do a market order, you're accepting whatever anybody is asking right now, meaning you'd be buying the 29 strike price for 30 cents, and you'd be selling for a nickel. Wow. Well, overall, you'd be paying 30 minus 5, or the natural spread of 25. That particular price, if you were to put that order in, should get filled immediately. Okay. The mid price is splitting these. You're doing what's called shaving the spread. You're trying to shave off a little bit in the hopes that you can get a better fill. And what happens is that somebody on the other side has to be willing to fill your order. Either the specialist, which is now pretty much done electronically. It used to be a physical person in Chicago that would make these and take these orders and match them up. they would either lay it off by matching it with another party, and this is all done electronically. Your broker sends in the order, the OCC takes care of all this matching up for you at the exchange takes care of that. The OCC makes sure everybody has the money and everything's taken care of if there's an exercise or assignment. But basically, if you want to get a better price, you can try for that mid, but the closer you get to the natural price, the more likely you are to get your orders filled. And you saw that where I had some pending orders when I first logged in. I can show you again. If I go to manage and bring this down, you can see I've got a strangle and a vertical that haven't been filled yet. Why? Well, because I put in an order, and you can see that my order was at 205. Right now, the mid and natural are nowhere near that. So I'm not likely to get filled. This strangle might, because the natural price is at 40, and that's where my limit order is. But the closer you are to the natural price, the more likely, it's not guaranteed, the more likely you are to get filled. Okay. So I wanted to point that out. Now, again, going into this analysis, I said I'm in a little bit of trouble with this position, and I can compare more time because I did not buy enough time. And right now on this particular position, when you look at it, the theta is 15 cents. Okay. That means I'm losing 15 cents every single day until expiration. And I believe that's showing per share. So yeah, it's showing $26. So yeah, that's actually $15. I'm not sure why it shows it differently, but it's 15 cents per day that I'm losing on that vertical spread. The other one is actually gaining because that's a short. This is a debit spread. And what'll happen is that'll decay even if prices move in my favor. And you can see based on time going by, actually, this is off a little bit. Let me change this as well, the graph. And it's nice that I can do this with the graph. You'll notice I use a little cogwheel right here. I can actually change my graph to show, let's just do 2 days right now. We'll do at expiration in white. We'll do right now in the blue. And actually, you know what? And I'll do one more in between, halfway to expiration. The reason why I do that is now on this chart, you can see, and I can zoom in to see it better. Okay. What we could do is we could see based on how much time is left, how much profit or loss we would experience. Because if I were to close this out currently, remember, I'm not going to lose the full, what was it, 45 cents that I had for full max loss. This is showing if I were to enter right now. And again, I did not get in there. I got in at 45. There we go. With a max profit 255. But currently, if I were to get out, if the price is currently about 18, well, I wouldn't lose the full 45. I would lose 45 minus the 18. And you can see that based on the time value right here. It's kind of hard to see. Actually, no, it's not. I can zoom in. I forgot. There we go. And there. White is at expiration. There's no time value left. The ice cube is completely melted. The green is halfway. The blue is right now. And you can see as time goes by, this melts further and further, even if price doesn't move. Now, if price does move, that's the other issue. Let's say this does finally start dropping. It drops down towards 26 bucks, where I expect it to go. And we'll go down to 27.50 right there. Okay, now we're dealing with what's called intrinsic values as well. So you can see how time changes and allows me to make some profits the further it goes on and the further down prices go. So you can kind of get an idea of where you think prices are going to go and how long it's going to take to get there. And here's another thing that's going to also help this position out. So this is not a total loss yet. There's still possibility. There's time left. The time value is eroding. That's hurting me. Okay. But what is going to help me are two things. If prices do start to drop, volatility should also start to increase. And that's where I started talking about all this. If I go here for a volatility adjustment, now remember, when I looked at the picture, if I bring it back, oh, I don't have it again. Go right here to my weekly on CNP. And you can see physically, when prices drop, volatility rises, doesn't it? Now, from the average, if it drops quickly like it has before, let's say we get the same kind of drop down towards 26 bucks, we are likely to see volatility rise from where it is currently at about 21%, should rise by 5%. Now, it may not exactly go there. Let's say it only goes 4%. Let's see what that does to our options. Right here under volatility adjustment, I could do 4%. And if prices stayed where they were last, obviously, if it expires, it'd be worthless. But if it does that, when we still have 8 days left till expiration, I do not lose the max. Again, it's prices didn't move at all. But if prices do move, because that's what should do, is drop and volatility rises, the closer we get to expiration, the faster it happens, the better for me. The closer it gets to expiration, as you can see, actually I had the other way around. We'd actually profit better. Now, if we do the opposite here, again, this is why we need to make sure we identify what's going on, both with volatility and time, as well as direction for the underlying security. This is the bear call spread that I did. Notice I sold, open this one up and close this. We can see it better. There we go. That's what I should have done in the first place. So we're comparing the two, right? The first one we just looked at was the long position, the debit, where we were buying a put and then selling a put. The other one here, right here, volatility adjustment. I should have done without the volatility as well, but start at 0 again. Doesn't work for live real positions. It should. It might be a setting that you're not having correct, but it should. Anyway, right here, volatility. I mean, you could do it for the simulations anyway, but it should also work for live positions. Anyway, right here, you can see right now, if we expire right there at 0, where current prices are, I'd only lose about $2. So I'm actually in a better position here on this. And how much price movement do I need to reach my max profit? I only need prices to go to $29. But when I did the long position, I actually need a physical move all the way down. Let's see, we'll add another price slice here. To reach my maximum profit, I need to go all the way down to 26 bucks. I need $3.42 of movement in the next 18, 19 days. Okay. However, the short position, the credit spread, in order to reach the maximum, that's last. I want to keep that there. And we'll make this one 29. I only need a 42-cent move. So that's in a little bit better position. Also, notice what happens with time. Even if prices don't move as much, let's say that it only moves down 20 cents. Our last price again was what, 42, 29.42? Let's say we move down to 22. Currently, that's plot 2. Notice it's changing. It shows me days till expiration. Currently, if we move down to 29.22, I'm still losing. But as time goes by, there we go. I'm not losing as much. And if we only move down that 20 cents by expiration, I'm actually making a profit. Whereas if we only move 18 cents on the long, I'm not going to be as good a position. Now, why was that a little bit better? If you remember all the way back to when I was looking to put on the position, one thing I noted was that A, I was looking to be a bit bearish on the security because we were near a selling area. B, we had a little bit higher implied volatility than we had previously compared to the average. So I expected implied volatility to possibly go down a bit. I didn't expect a huge move like I saw before, because remember, on the daily chart, we actually had a lot of momentum. So by taking all this into consideration, understanding the underlying security is going to be bearish, but not extremely bearish. It might just go a bit sideways. Volatility is a little higher than average and possibly getting ready to go down. That means the options were slightly overpriced and looking for a possible move down in pricing as well as volatility. That meant that my better strategy, and it still has a better probability working out, is to take the credit strategy and sell options versus buying the options. So we'll expand upon that. We're kind of running out of time here, so I'm going to wrap it up for now and maybe take a look at some of the Q&A to help you guys out as well. But basically kind of tied this all together where, again, I started off looking at, and I'll go back to my chart. There it is, CNP. I think it was on the weekly where I have the text. Is that the one? Remove. Oh, that's why it's back here, isn't it? Got to find my text again. But remember the 3 steps, if you will. Step 1, was it this? I hope I didn't do it on a different security. I think I might have. Anyway, I typed it in earlier. My step 1 is to figure out which direction the underlying security. Oh, it's ADM. That's what it was. ADM. Hopefully. Where are you? I lost my text. It was daily. Sorry. I hope I didn't delete the text. I might have. Anyway, my 3 steps, as I said before, figure out underlying security, which way it's likely to move. Number 1. Number 2, figure out if options are cheap or expensive. And step 3, try to put on the right strategy based on that. And yeah, for some reason, it's not showing the text anymore, unless I must have deleted it. Sorry. But I repeated it, and it is on video. So let's see. Questions. Would an implied volatility theta ratio indicate which one to dominate? Possibly, but you kind of want to look at maybe percentage versus the underlying premium to see what kind of an input you're going to have. And you can actually, as I was showing you before you get into the position, Chris, you could actually experiment with the price slices to see a change in IV or a change in theta, which one's going to hurt you more or help you more. So remember, I was saying on the debit strategy that I was in a little bit of trouble because I did the 18 Octobers. However, if I went in on CNP again and bought more time and do the exact same strategy, this was the 29 and 26. So we're buying the 29, selling the 26. Gotta get rid of the other ones there. Octobers, and then analyze. And I can compare them and kind of see based on, and that is the wrong one. There it is, the longs, the 2 different longs with the different expiration months, and kind of see, okay, delta is about the same. That's not a big deal. Price obviously would be paying more, but when it comes to our theta, I'm reducing that theta decay by a half, but I am increasing my volatility exposure. So I really have to see, is this the wise one to do? Because I'm going to have much more exposure to volatility with much more time left. So that's something we'll explore a little bit more in the future when it comes to kind of choosing the right types of strategies to put on. So hopefully that answers the question there. Any other questions? Start learning options, new to options altogether. TradeStation has a bunch of education. Again, we're putting together pieces and we're going to be reorganizing. Not we, I said they're going to be reorganizing. When it comes to this options education center, there's going to be kind of a step-by-step. If you're a beginner, kind of what strategies you may want to look at first and learn versus more experienced traders, as well as bullish strategies versus bearish strategies. The other nice thing is in the platform itself, if you're not quite sure what kind of strategy you want to employ, if you go, I was in the right spot. You do your underlying security analysis first. So say we were looking at Apple, okay, and we decided that Apple was bullish. I could type in Apple, and one of the tabs here is search. You could actually go in under the search tab and say, oh, you know what? I am kind of bullish, but I want to limit my risk. And you click on that, and you can say, okay, well, I expect Apple to drop, or sorry, to go up. We're doing bullish. Let's say we expect Apple to go up by 4%, and we're going to be holding on to this trade for the next month or so. You can actually put in a lot of these little criteria here. There we go. Well, I'll go 31st, close enough. And volatility might change. Well, if it goes up, the volatility might actually drop by, I don't know, 3%. We can play around with that. You can look back and see. And then you can run your search and see what the different strategies are that they're putting in. Some of these will be single legs. It looks like it's just buying an option basically right now. But what you'll learn as you start doing more and more options, instead of just buying an option, if you do the vertical spreads, you'll actually reduce your risk and reduce your cost. And that's where we did a lot of the focus when it comes to the Options Education Center. And that's why I wanted to start talking about some of those things, because when you go to the Options Education Center, you know, one of the things we talked about today is, how do I know, should I be doing the bullish or the bearish? Well, we look at the underlying, whether I should be doing a debit or a credit. And some of it's based on implied volatility. So we're going to focus a lot of these strategies and utilizing this stuff and figuring out what is the best thing for us to do based on the situation. But yeah, for instance, you can search. And like I said, if you were looking, I don't know if I can just do, let's see, there we go. Instead of just buy, put, and calls, let's see if it gives me the spreads. Nope. I can search through these, as I was saying. I didn't know if there's a way to limit it to just multi-leg strategies. There might be a way to do that. I'm just not sure of it right off the top of my head. Oh, there we go. We can actually just do vertical. There it is. And there are the vertical spreads. And now you'll notice in blue, those will be long vertical spreads. You can actually expand the columns to see what they are. And for instance, if I click on this red one, I should be able to do an analysis on it as well. As I go through it, load it in my analysis chain. It is a vertical spread. It is selling the 35, buying the 35, selling the 40 puts. That's a bull put spread. Well, then I go to my education center, and right here we look for bull put spreads, learn more. There you go. So that's a good way to start, is actually just trying to learn, okay, if I'm bullish or bearish on security, what should I be looking to do? Which ones are going to give me better opportunities? And then learn about those opportunities here. And of course, ask us.
Yeah,
So,
for sure.
anyway,
For sure.
I got to get going. So yeah.
Thank you, Brandon. That was a good presentation. I learned a few things that I didn't know. So thank you for that, Brandon.
No,
Hope
thank you.
everyone enjoyed the class too. I just sent out a poll just in case you have a couple more minutes. We would appreciate your feedback on our education. So take some time to fill that out. But Brandon, thank you again. And we do this on a bi-weekly basis. So our next presentation would be, what is it? October 14th, I think, is the next options replay.
Yes.
This webinar, as well as the one we did 2 weeks ago, are going to be, well, the one 2 weeks ago is already posted. But if you go to the Options Education Center, you're going to see a banner for options replay. It'll give you access to all the archives. So make sure that you check those out. Brandon, again.
And for feedback, they should email us email at what address? It's the.
I'm sorry, what did you say?
Oh, for feedback, and if they have questions of what they'd like to see in future sessions, where should they contact it?
The email address that I just submitted right there in the chat, education@tradestation.com. We'll provide you answers. We're in contact with Brandon all the time, so I'm the one bugging him all the time to give me some options answers. So Brandon, again, thank you so much for your time. Okay, and everyone who's joined today, thank you for your time, and I hope to see you in one of our future classes. Goodbye, everyone. Have a good night.